It's time now for our Muni moment, and today we're going to focus on how falling U.S. Treasury yields are affecting the municipal market. And here to do that with us is Kim Friedricks. She is Fixed Income Managing Director over at Kayne Anderson Rudnick. And Kim, let's start with your notes and that Muni Treasury ratio, because as you point out, in October it was between 70–75% typical levels. Right now it's at 59%, which means that munis have gotten expensive in a hurry. How sustainable is that?
You know, in some ways it is, in some ways it isn't. Right now you have a huge amount of money that's going into fixed income, and a lot of it's going into ETFs, mutual funds that need to get invested, and they just want to get money to work. So I think a lot of that is just people putting money right in. Now, people like myself that are doing more, SMAs and paying attention to that kind of thing really don't want to buy into those kinds of tight levels and get involved right there. Something underneath 60% just really doesn't make sense.
And talk to us about the relative valuation here, because, I mean, we're talking about the past 2 months or so, this big rally that we've seen in munis outpacing even what we're seeing in the Treasury market. Looking into 2024, I mean, where do you see the bigger opportunity? I know it's not necessarily an either-or kind of market setup, but which market stands to benefit more from this Fed backdrop?
Oh, I think definitely munis, always. I mean, munis are always going to be, to anyone who's paying taxes, munis are always going to be the place to be. You're always going to get a huge advantage there, and that definitely helps out. Now, they have tightened extremely quickly in this last month, but going forward, when that eases up a little bit, when a little of the kind of year-end window dressing pressure goes away and we get things back to normal, then it's definitely back into munis and time to get involved. I mean, you're talking about very high quality credits and a lot of yield without paying taxes.
And not only high quality credit, Kim, but something that I've found interesting over the last few months are the number of companies and issuers that we've seen actually get upgrades from some of the ratings companies here. The idea that some of the companies that it looked like they were really against the ropes maybe at the start of this year, at least in the eyes of some of the credit rating companies, maybe they finally sort of put that behind them.
Well, yeah, a lot of issuers kind of going into the pandemic, whatever situation they were in, they've got a huge amount of funding during the pandemic. And what we're seeing now is coming out of that with the pandemic funding going away, all of that boost to everyone's revenues, all the big tax revenue surges, everyone's being upgraded. We're seeing just under 5 times as many upgrades to downgrades from most of the rating agencies right now, which is just huge. The big thing to watch going forward is going to be how well they sustain that. Did they use those funds in the right places? Are they, did they get their reserves in line? Did they pay down, say, a pension obligation? You might think back to New Jersey making their first full pension contribution in something like 20 years a couple of years ago. And they've done it, 2 budgets in a row. So, taking advantage of the bump in funds to kind of use it right and pay things down.
I am curious. I just want to ask you a broader question here, Kim, just about kind of the attractiveness of being in this business. And particularly, I don't mean necessarily trading in the secondary market or even buying the issues, but for some of the firms that help to underwrite this. We've seen some of the big Wall Street banks retrench a little bit with regards to some of their public finance units, Citigroup itself getting completely out of it. But you have others that basically have just said, we're kind of whittling away around the edges because they don't see as much value in it relative to, I guess, what they can get in other areas of fixed income and dealing with those markets. I am curious about the competition between fixed income assets right now. And I know the tax advantages that munis have, but when you adjust that for whatever additional growth you may get elsewhere here, how does it compete?
Well, really, there's two things about munis. There's the fact that you actually get the tax advantage, and then there's the fact that the income that you're getting from the munis is not added to the top of your your income pile and then sort of written off. It just plain doesn't get added in. So in that sense, it doesn't ever bump you into another tax bracket. So there's a lot of advantage to the tax-free income. From the perspective of the business side, city, leaving and other firms moving out, you're seeing a lot of the regionals pick up that business. But there's also been a huge lag in issuance versus what you would expect right now, just basically because rates got down to nothing and have come back. And if you didn't refinance your town's debt when munis were paying 1%, why are you issuing new debt to do it now? So I think this tightening in rates is going to play into the hands of a lot of muni managers, municipal managers who waited to issue debt, and they're going to get an opportunity now. But as you stated, they're probably going to end up going with a regional dealer rather than city or one of the big guys.